Okay, everyone, due to a lot of demand, we are continuing on with our deeper dives. Now, what we're going to do is we're looking at PayPal. PayPal has fallen a ton in the last year and a half, 2 years. Is it a buy? Is it not a buy? Remember, we're value investors. Mo and I right here are value investors. Our goal is to look at a company and determine if we should buy it based on the price movements of the company. The value, we think, will stay very consistent and grow over time. But we want to take advantage of the market's reactions to the price in order to decide if we're buying or not. And what we love is when we see a company that has fallen such a big amount. I believe, what was PayPal's peak, Mo? $3.11, and now it's down to $95, $96. So we're going to do this deeper dive. Now, this doesn't mean that everything we do here is all you should consider. It's just looking at how we're going to view the company, and we'll probably say along the way, hey, you know what? Something to look at further would be X, Y, and Z. So if you have our software, pull it up. If you don't, check it out on everythingmoney.com. But I'm going to pull up PayPal here. Let's first go through our 8 pillars. All right, so here is the, actually, here's the stock first. Wasn't $3.11 a band back in the day in the 90s for Tim and I? Yep, Tim's nodding his head.
Tim's
so,
saying yes.
Okay, it is off its low. It did hit a low of $70 in the last few months back in July, and now it's at $97. Oh, up quite a bit today, 2.5%.
Yep.
So let's go right to our 8 pillars. All right, Mo. So when you see these 8 pillars, what do you see?
These are the ones I like because I just know just having that 5-year PE being high and the 5-year price to free cash flow being high, it's overvalued.
Another thing, though, if you look, there's a difference between the 5-year PE and the 5-year price to free cash flow. Free cash flow and earnings should be similar over long periods of time. But this tells me right here that there's more free cash flow than earnings, right? Because it's price divided by earnings and price divided by free cash flow. For this to be lower than this, it means this has to be higher than earnings. So that's a good thing. Usually companies, when you see the opposite, you start to wonder, wait a second, why are they showing more earnings than cash flow? I'm not saying it's a scam when that happens, but Enron was a prime example of that. They showed a ton of earnings with very little cash flow. So here, I like this. Now, why do we like this so much? It's easier for price to fall than fundamentals to get better, right, Mo?
I mean, looking at this company back a year ago when it was $300 a share, we were saying we're not even close to liking this thing.
Yeah.
And now we still have the same fundamentals, the same metrics, and now the price is probably a lot closer.
Yeah, but at this level, a company can grow into this value. Remember, companies that have a lot of growth potential, you should be willing to pay more money for because they're going to grow their revenue and profit and free cash flow at a much higher clip. A company that's stagnant, growing very little, you have to pay a good price for it or else you're not going to get that extra value, right?
Right.
So, no dividend being paid, but here's another thing I like. 5-year average free cash flow of $4.3 billion, and last year they did 5.2. So one of the things we're going to find if we look at our income statement, let's look at the income statement. Over the last, look at this, big jump between 19, 20, which made sense because of COVID, 21, still factoring in COVID. But guess what? They still grew in 22. Yep. That's what I like right there. They still grew through the end of June of this year. So even though what you saw happen a lot with a lot of companies in COVID was a massive increase in revenue because people had to use them, right? And then a drop in revenue because people are like, hey, I can go out now. I don't need to do this. PayPal, they got more market share. They took a big chunk. And then guess what? They kept it.
And people stayed with them.
Yes, people stayed with them.
I think this is kind of a company where people realized they didn't even need this. And then they used it and they were like, ooh, this is convenient. I'm going to keep using this.
So it's interesting. Mo, we've talked about PayPal in the past and you're like, well, Apple Pay, but they're different things.
They are.
Go ahead and explain that.
I mean, for me, and it wasn't until you said it, when I go and buy something weird, not on maybe an Amazon.com or whatever, what do I want? I want security. I want PayPal. I have my credit card backing me up and then I have PayPal backing me up. It's not that I go use Apple Pay. I don't use Amazon Pay. I use PayPal. And that, to me, just having that security behind me, that's a good thing. And I think people realize that.
Yeah, and Apple Pay is merely a facilitator. I don't think they're actually back. You still have to go to your credit card company to charge, to do the charge. Correct. So with PayPal, there's that extra level of security, and they own Venmo.
Yeah.
I love Venmo.
It's great.
It is great.
I think it's the best one of those paying apps. I mean, people have Zelle and Cash App and stuff. I think Venmo's the best, but maybe I'm biased.
I think Venmo's better than Cash App, and I do think it's better than Zelle. However, Zelle is making major breakthroughs because they're partnering with a lot of banks directly. So we'll get into more of that shortly. But the profit, interestingly enough, even though revenue is up a ton, the profit this last year was not. They generated the same profit they did 5 years ago, even though revenue is up from 14 billion to 26 billion. So first question I ask, why is revenue up? How much is that? Almost double, but profit is the same. Yeah. So you got to find that out in this company. Let's go back to the 8 pillars here, because look at this. So revenue is up 11.7 billion. Net income's up only 19 million. So call it the same. But look at free cash flow. Free cash flow's up a ton. Jeez. So I want to go to the income statement immediately and say, okay, are there any write-offs that I need to look at? I don't see any. Well, there's $1 billion write-off right here. Other income and expenses, $974 million. So I'll have to dribble again. What's that $1 billion in other income and expenses for?
Yeah.
Right?
While you did that, I went over to see any acquisitions, dispositions, and there were none.
There were none?
There were none in 2022 or 2021.
Well, it might have been a write-off from a previous acquisition. True. So what Mo was talking about here is, and you can look at this with Juul. Juul was bought by Altria or somebody.
Altria.
And they wrote off a big chunk of Juul, but they make the acquisition in 1 year. It doesn't go against the income statement. It doesn't even go against the free cash flow. It's below free cash flow. They do that, but when they're ready, when they sit there and say, oops, we kind of overpaid, they do a write-off. And that does hit the income statement, but does not hit the cash flow statement, right? So that's what Mo was talking about here. Now, analyst estimates. I'm going to go to analyst estimates. Now, one thing, keep in mind, Mo's actually on the 10K, yeah. But look at this. We have the 10K on our software. For those of you who don't know, you go to annual reports. It takes you right to the SEC website for that company. You click this link, 10K, and find their most recent 10K. Boom. And guess what? It pops right up. You're a few clicks away on our software to the 10K. But let's go sit here and look at the analyst estimates while Mo looks a little bit. So keep in mind, guys, our software is pulling 51 analyst estimates. We get a data feed. That data feed happens to be these 51. These are not the only 51 analysts analyzing PayPal. There are way more. So one of the things you can do as part of your research is to go find the other analysts. But look at the EPS. They're going to have a 15% drop this year, but going forward, they're basically 20% growth per year in EPS. They're over doubling according to analysts next 5 years. Revenue, not quite doubling, but look at that. 28 billion to 48 billion. So even with a lot of and my biggest concern about PayPal is the competition out there. Mm-hmm. There's a lot of competition out there. Just like streaming, there was a lot of competition. The question you have to ask yourself is that going to come to the point where there's a consolidation? So let's go, before we look at anything on the stock analyzer tool, I really want to look at some attributes of the 10K. So some of the things I found. Mo, what are you looking at the 10K that you like?
I'm looking for that write-off thing and seeing exactly what that was or what that is.
Well, it might have been this year.
So
you have to look at what our data does. So right here, guys, something to tell.
Go to quarterly.
You can do the annual, which would go by year, and the actual 10K, or you can do 4 quarters, which basically looks at pulls last 4 quarters at a time. That way you're looking at 4 quarters at a time as opposed to just waiting for the full year to be done. So that might have been, and actually let's look at this, Mo. Let's go to annual, and it was not in their, it was not in their last, it was sometime this year. Because if you look at special income and charges, I don't see it in here.
Okay.
So it was sometime this year.
That's why I'm not finding it.
All right. Now, I'm going to pull up some things from the 10K that I liked a little bit. So one of the things I like about PayPal, they do a lot of graphics in their 10K. So this is the family of PayPal. Collectively connect to 426 million active accounts. And there's a breakdown. Of those 426 million, 392 million are consumers, 34 million are merchants. So going forward, you're going to want to pay attention to how PayPal is growing that number. That's a lot of people. That's over the US is 330 million people. Now, obviously, this is an international company, but they're very active worldwide. 2021 key performance metrics. 13% increase in their base from 2020. Remember, 2020 was the year of COVID, and they had a lot of people jump onto PayPal to use them. 25% increase in customer engagement. Market share, 33% increase from 2020. So guys, I love the fact that they actually exploded in COVID and then grew on that in 2021. Mo, wouldn't you say that's awesome?
Yeah, that's incredible.
Now, I want everybody to know, I have a bias. I'm a big fan of PayPal.
Yes, you are.
I do not own PayPal. I have puts on PayPal at a much lower price, but don't go doing that. I'm selling puts to buy PayPal at a much lower price than today. And at any time, my views could change based on new information that comes up, because that's what I do as a value investor. My job as a value investor is to take all information and decide which information is useless and which information is useful that will change my long-term value of the business. And that's what we're trying to do here as value investors. So they also explain what an active account is, number of payment transactions. They explain all of these in the 10K.
A big risk factor that you need to pay attention to, I think, is this crypto space. Luckily, I don't think that they've gotten too heavily involved in crypto. Like, it's not like a Coinbase where they just went all in on crypto. So that is a good thing. Another thing that you really need to pay attention to, privacy. Privacy is a very big thing going forward, especially because you're dealing with people's money. You see Meta, I'm totally different space, but Meta is dealing with these privacy issues. I think you're going to start seeing a lot of these privacy issues come about. They're heavily involved on Apple's platform. That's a big thing that you need to be concerned with. It's not so much concerned with, but follow it. Follow along with it. And those two are their first two risk factors. So you need to pay attention to those.
Now, when it comes to risk factors, guys, our good friend Gary, he loves reading the risk factors. I personally believe a lot of the risk factors are generic things like, oh, if all of a sudden people stop buying stuff, we're going to actually be hurt. If all of a sudden our ability to get new customers sucks, we're not going to be able to grow. It's like, okay. Now, with that said, there will be some risk factors in there that might disclose some very specific points. So it all depends on your style. My style is to skim the risk factors and see where something pops up that goes, wait a second, what happened here? Go ahead, Mo.
Like this one. This one says the continuing effects of COVID-19. If these keep happening, they could be detrimental to our business.
Yeah.
Thank you. Of course. Those are the kind of things you might find in the risk factors.
Now, you got to remember, I've done real estate funds before. I've put them together. And whenever I go with the lawyers and say, listen, we're going to have to give you the generic risk factors, like, hey, if we're not able to rent these units, this investment's going to suffer.
Yeah.
If we're not able to get financing, this investment's going to suffer. Things like that are very generic. Are they plausible? Of course they are, but you have to decide for yourself which ones are really the important ones. Now, one of the things they talk about in this is share repurchase. So in the 10K, they're going to talk about the share repurchase plan. I don't like this very much. They bought 8 million shares back at an average price of 187. That's well over $1 billion. I don't like that. Why? Because at those prices of 190, if you look at our past PayPal videos, that's really expensive. You don't want the company buying back expensive shares. They're taking their cash. They're taking your cash. You have an ownership interest in that cash. And they're taking that cash to go buy expensive shares. It's no different than them buying in another expensive company's shares as an investment. When they buy back their own shares, they're essentially using the cash to invest back in themselves in some fashion. I do not like that, especially since they don't even pay a dividend. So the argument can't even be made, hey, Paul, we pay a 5% dividend. So when we buy back shares, we're at least saving 5% on that cash flow. Not even doing that. So I'm not a huge fan of this. I want them to wait till the shares are so incredibly cheap that you have to buy back shares as a way to give value back to investors.
Good news is they didn't buy back any shares in 2020, 2021. So they stayed consistent.
No, 2021 they did.
Then is that late 2021?
Yeah.
Okay. So they didn't do any when the price was like $300 a share. So that's good.
Yippee! That's good. I mean, they only overpaid by a little. I mean, it was still a big number.
Overpaid by $100 a share.
Right. So right now they're $90 lower, almost half the price, right?
Yep.
So this company is involved in transactions. So one of the things I want to look for is this right here, the number of payment transactions per active account. Because remember, guys, this is like retail in the sense of same store sales. Are they increasing the amount of which each active account is using them? And here's what I like. 2019, the average account, 40.6. 2020, 40.9. So they gained a lot of users and they stayed steady on the number of transactions. Here's what I like. 2021, massive increase. Look at that. 45.4 transactions per active account. And in here, they're going to explain to you what that is. So that's another benefit of this. Like these are the kind of data things I want to sit there and say, hey, are they just growing by adding more accounts? But when they add more accounts, people are like, they're growing and the number of transactions per account is growing along with it. I like seeing that. What do you think, Mo?
Yeah, that's a good thing. And something that actually stood out to me about this was, I don't know if you guys remember this, but they were looking at acquiring Pinterest sometime in 2021. And that actually worried me because they wanted to do it for user growth. And my initial thought was, oh no, they're worried about their user growth. But after seeing the numbers that came out in their 10K, it makes me feel a lot better. There's no doubt about that. So hopefully they continue to grow. I mean, I don't see why they wouldn't. They're doing a really great job of it.
Yeah. Some other things. Percent of consumer loans and interest receivables that are current, 97%. This is what I actually found was interesting. December 2020, they were at 98%. So they actually went lower, which I was kind of surprised about. And the net charge-offs were actually higher. Now, one thing that could be is the ones that were in default in 2020, they finally just went and charged them off. I don't know, but this is an alarming thing for me, 2.4% to 4.3%. I don't know. So one thing to do is go back to 2018. So what I'm going to do here is I'm actually going to go back to the 2018 10K, and I'm going to find out what was it back then. So I'm going back to the SEC website. Annual report for 2018 10K is right, because it's the 2019 one. So what am I looking for? Percent of consumer loans. Percent of consumer loans. All right. So it was 3.9% in 2017, 3.1% in 2018. Okay, so these are the things. You want to compare these data points to past years. It is a lot higher in 2021. So definitely something that's like, okay, got to watch that. Is it because the economy is slowing? I don't know what the reason is, but it's something to definitely keep in mind.
Did you talk about number of payment transactions per active account?
Yeah.
Okay, that was up 12%?
Yeah.
Okay, good.
Yeah, it went to from 40.9 to 45.4,
Yeah,
something
it's
crazy like
incredible.
that.
That's great.
That's exactly, it's great. Another thing that I saw was their total operating expenses. So I want to look at their operating expenses. This is an overall feel for their operating expenses. Sales and marketing is up, which I like. Customer support and operations. Listen, look at these growth rates. Are these growing faster than revenue? They are not. Revenue is up a lot more, but they're still adding more customer service reps, which is a big thing.
Mm-hmm. Especially for that business.
So operating expenses. So operating expenses. So right here, guys, these are operating expenses from 2019, 20, and 21. And here are the categories. Transaction expense makes sense. However, I will say something interesting that I don't know if it's a dollar for dollar increase percentage-wise. Customer service and support, restructuring, general administrative, technology and development. I want to see technology and development increasing. Mm-hmm. Are they investing back in themselves to make better technology, make it so that people want to go to PayPal more and more and more? I love the fact that when I go to all these random websites, I just click PayPal, I log into my PayPal, and it immediately fills in everything for me. Yep. Is that simple? Yeah, but I still have that PayPal protection along the way with it.
It's something.
Yes.
Nicole just got scammed the other day. She used PayPal. It was okay.
What was the scam?
The shoes.
Oh, that's right. Mo, why don't you tell that story?
So I really wanted these Jordan golf shoes. Nicole found them. They were Masters edition. She bought them, and it was a total scam, but PayPal had her back, and that was a good thing.
How fast did she get the money back?
Oh, it was like 3 minutes.
Come on.
It was so fast. It was so lightning fast.
So this is part of the idea of what we're looking at in a deep dive. Again, it's not over and done with just from here, but get a feel for it. There's a few. The only thing that really alarmed me was their write-offs of 4.3% or whatever it was. That's kind of like, okay, that's a bigger number. Mm-hmm. So what's their guidance? That's another thing to look at. But let's go to a stock analyzer tool. Now, guys, the reason I go to stock analyzer tool here is every investment is the present value of all future cash flow. You've heard me say that 1,000 times. But we don't know the future, so now it's time to make assumptions. Now, if you remember, the analyst estimates for the next 5 years were low to mid double-digit growth, and from there, we want to go to the next. I want to go 10-year analysis. So it's probably going to slow down further. The bigger and bigger the company gets, the harder it is to grow. So I'm going to take these ideas and transfer it on to our stock analyzer tool.
Actually, quite surprised by this number.
I was surprised as well by the revenue growth numbers,
especially with 27 analysts.
Yeah, 27 analysts have set there, and the range is between 45 and 50 billion dollars, 46 and 50 billion dollars in 2026. So there's some growth. So I'm going to sit here on the high side and call it 10% revenue growth in the next 10 years. I'm going to go 4 in the low side, 7% on the high side. Now, is 4% very low? Absolutely. But my goal is to be conservative and wait for companies to sell for my absolute I must buy price. Now, profit margin. In the last 10 years, I saw roughly 12 to 15%. So I'm going to go low side, 9, 12, and 15. And as they grow larger and larger, guys, I think they're going to have a higher profit margin because this is a transaction business, more service-oriented. Mo, can you go to the metrics page and see what's their gross margin? So this is going to drive a lot of stuff right here.
Gross
51%.
51.4%.
So guys, 51% gross margin. That means every dollar they sell is 51 cents to the bottom line. Yes, they have operating expenses in between, and those will go up with it. But if they drive more and more profit, this is what I like about the business. They just need to get more and more transactions in, and they get people doing more transactions, and they're going to really drive that bottom line price. That profit margin could actually be, I'm going to go higher.
Could be higher, yeah.
I'm actually going to go even higher. I'm going to go to 25 on the high side.
And they've shown that 12% increase.
Yeah, so I'm going to go 10, 17 and a half, and 25. Free cash flow margin. Oh, and by the way, look at their free cash flow. It justifies it. I'm going to go 15, 20, and 25. Now, PE. Now, guys, PE right now is 53. That's way too high. The historical average for stocks is 15 PE. Now, for a company that has a high return on invested capital, which they have, and some growth potential and such a big gross margin, I'm willing to go higher, but I'm going to go 14, 16, and 18. Because, guys, it's still, as it gets bigger and bigger and bigger, the growth potential is lower and lower and lower. That moat will probably get bigger, but it's harder to grow as a company, so I'm going to go a little bit lower. Now, for desired annual return, so guys, this is what I like to do. When it comes to companies with such a big range, I'm going to go with the lower desired return here. Why? Because I'm making much lower assumptions, so I don't need as much margin of safety. I've already put a little bit of margin all the way along here. For the middle, I've gotten a little bit more aggressive. And for the high, I've gotten really aggressive. So I'm actually going to go 13, 16, and 19% desired return. Mo, what do you think of those numbers?
I mean, if you're looking at profit margin of 25%, that's probably pretty good.
Actually, you know what? I'm going to go 12, 16, and 20. Because you're right.
It's high.
That's a really high expense. Exactly. And I think the low side, I'm being very conservative here on the low side. Yeah, sure. So I don't mind going with 12%. Sure. Now, guys, when I hit the analyze button, 6 numbers are going to pop up. A low, middle, and high based on earnings, and a low, middle, and high based on free cash flow. If it's all green, it doesn't mean go out and buy. And if it's all red, it doesn't mean go out and avoid. If it's all green, verify that these are accurate. How do you do that? The same thing we did. But pull the layers back a little bit more. Go see other analysts. What are they saying? Go read, but also join the community. It might be worth it just to investigate one stock. If you're going to go spend a few $1,000s on a stock, go spend the 1 month and $30, $1 per day to get this community. There are thousands of active members in here. You get all this software. You can talk to them. You get it all on your phone. It's so easy. Just go do it. It's worth it just to investigate one single stock and get people's opinion on it. Might be worth it. If it's all red, but it's close, add it to your watch list. Add it to the watch list, and it'll notify you when it hits the desired price. So, Mo, what do you get? Did you already hit it? Did you already look?
I hit it, but it falls right in the range of what I thought it was going to sit in and what the analysis has been in the past.
Great. So here's the deal.
It's always there.
Low side of 30 to 45, high side of 80, mid price of 50 to 60. And guys, it's on my watch list at $70 right now.
It's always there.
Because I don't think I want to buy it at 70, but at 70 when it hits, I'll start getting active and selling puts at much lower prices.
Yeah, exactly.
So that was our deep dive on PayPal. You need to go watch our next video about margin of safety, and don't forget to subscribe to our channel. Thank you very much. The recent 12-year bull market has had very, very few interruptions. The biggest one was the pandemic. As a person who's considered to be a perma bear, which is somebody who always thinks negative about the market,